Today we are talking about personal finance. A quick disclaimer: I am not a financial planner, banker, stockbroker, tax advisor, or an accountant. This presentation is for informational and educational purposes only. For specific financial questions you have, please consult a professional. So, why did I make this presentation? Well, personal finance is important for all of us to be educated about, regardless of what profession you are in. Nobody's going to do it for you. You have to educate yourself about how money works. According to lendingtree.com, Americans have $841 billion in credit card debt as of 2022. According to American Bankers Association, Americans carried a balance on their credit card on 53% of all active credit card accounts in the fourth quarter of 2021. That means they didn't pay off their credit card at the end of the month. They carried that balance over into the next month and had to pay the high interest rates. According to lendingtree.com, in 2022, the average credit card APR in the first quarter of 2022 was 14.56%. Also, a 401k account is one of the best available retirement options for many people. However, just 41% of eligible workers contribute to one, according to the U.S. Census Bureau. According to a CNBC report, 56% of Americans cannot cover a $1,000 emergency expense as of January 2022. So emergency expense might be something like your car breaks down, the water heater fails, your roof gets damaged in a hailstorm, etc. Financial Planning 101. So number one, you want to start by making an itemized inventory of your current finances. What's your monthly income? What's your monthly expenses? You can do it in a spreadsheet. You can write it with the pen and paper. Make a monthly budget and allocate every dollar for a specific purpose. You want to know where every dime is going. Number three, pay off high interest credit card debt. You can even call your credit card company and ask to negotiate terms, interest rates, settlement amount, and payments on credit card debt. Number four, cancel unused, unnecessary subscriptions like cable TV, landline telephone, magazines, gym membership, etc. Call your utility companies and ask if they can offer a discount on your utility services. Many times, if you bundle your home internet and cell phone service together, you can get a discount. If you opt for paperless billing, sign a 12-month contract, etc. Get multiple price quotes for car and homeowners insurance or renter's insurance. You want to shop around for a better rate. Here too, you can bundle your homeowner's insurance with your car insurance. Number seven, participate in your employer 401k plan if they offer a dollar for dollar match up to a certain percentage, because that's free money. An employer HSA is a health savings account. It's another great investment vehicle. Money that goes into an HSA goes in pre-tax, grows tax-free, and can be withdrawn tax-free for qualified medical expenses. You can even earmark a portion of the funds in that account for short-term needs to take out to pay your medical bills, and then leave a portion of the funds in the account for long-term growth and actually invest that portion of funds in the stock market. So essentially that money will earn you money over the long run. Number nine, have a 3 to 6 month emergency liquid fund in a high interest earning online only savings account like ally.com, for example. You want to keep enough cash in your regular checking account to cover monthly expenses and deductibles. Number 11, shop around for a different bank, credit union, or brokerage account. You want to find out what fees are you currently paying, what are you being charged, if any. Some examples of some reputable ones you can think about would be Fidelity or Vanguard. Number 12, consider opening a brokerage account like an IRA, a Roth IRA, etc., especially if your employer does not offer you a retirement account. Lastly, think about doing an annual net worth statement to keep track of your financial progress over time. So this is the financial order of operations designed by the money guy. His name is Brian Preston. He is a financial advisor. He's a business owner. He was a tax preparer for many years. He has his own YouTube channel called The Money Guy. And he came up with this system or order of operations. So number 1, make sure your deductibles are covered. Number 2, get that employer match like in your 401k. Number 3, pay off your high interest credit card debt. You don't want to carry your credit card debt into the next month. Number 4, have an emergency fund. So if something bad happens, you lose your job, your car breaks down, etc. Number 5, consider investing in a Roth and or HSA. Number 6, max out your retirement account contributions. So there is an annual cap as to how much money you can contribute to a retirement account depending on your income level and what type of retirement account you're investing in. Number 7, hyperaccumulation phase. Number 8, you can pay your future expenses, for example, your college tuition for your kids. Number 9, pay off low interest debt like your mortgage. And again, this is from moneyguy.com. So most common investment accounts, we won't cover all of them today, that would take too long. But you got a 401k, money goes in pre-tax, it's taxed on withdrawals. You can withdraw that money at 59 and a half years old without penalty. A traditional IRA, the maximum annual contribution limit is $6,000 as of 2022, or $7,000 if you're age 50 or older. Contributions may be tax deductible in the year they were made. Investments within the account grow tax deferred. Withdrawals in retirement are taxed as ordinary income, and you can withdraw money from those accounts at age 59 and a half. A Roth IRA is a tax-free growth account, and you also can realize tax-free withdrawals in retirement from a Roth IRA. And there's no requirement minimum distributions from a Roth IRA, whereas other retirement accounts do have required minimum distributions. So once you reach a certain age, the government says, hey, you need to start withdrawing money from this account, because obviously they want to collect tax money from you. What is the 3-bucket investment strategy? The first bucket would be your pre-tax bucket to put money into. That would be like a 401k. Then if you have money left over and you can afford it, you can put money into a tax-free bucket like a Roth IRA and or HSA. Usually with an HSA, my understanding is you have to have a high deductible medical insurance, if I'm remembering correctly on that. And then the third bucket, an after-tax bucket, would be like a traditional IRA and or a brokerage account. Asset classes. Historically, the 3 main asset classes have been equities or stocks, fixed income or bonds, and cash equivalent or money market instruments. Currently, most investment professionals include real estate, commodities, futures, other financial derivatives, and even cryptocurrencies in the asset class mix. Investment assets include both tangible and intangible instruments, which investors buy and sell for the purposes of generating additional income on either a short-term or long-term basis. Keep in mind when you invest your money in the stock market, whatever type of account you invest in, whatever stocks you buy, when you go to sell those holdings, you're subject to capital gains tax. So there's short-term capital gains or long-term capital gains. Short-term would be if you held that investment for less than a year, you'd be subject to that higher tax rate. Whereas if you hold on to your investments for 1 year or longer, you're taxed at a lower tax rate. So risk capacity versus risk tolerance. Risk capacity is your actual monetary and time capacity to weather the ups and downs in the market. So that will help you determine how aggressively you want to invest or how conservatively you want to invest. Risk tolerance is how well can you stomach the ups and downs in the stock market. A low risk tolerance person might lose sleep at night if the stock market falls, whereas someone with a high risk tolerance might not be bothered if the stock market falls. So the power of compound interest. This is important. Compound interest is the interest you earn on interest. So it's basically money making money. This can be illustrated by using basic math. If you have $100 and it earns 5% interest each year, you'll have $105 at the end of the first year. At the end of the second year, you'll have $110.25, and so on. This chart is an example of investing $5,000 every year into your retirement account, assuming an 8% annual return compounded monthly. So you can see the light green line at the bottom of the chart is your consistent $5,000 going into the account every year. But then you see the dark green curve, that is your earnings. That's the interest your account has earned over those years. So you can see the longer you're invested, the more money you'll earn in interest on your investment accounts. So historically, the stock market recovers 100% of losses and grows after every downturn. This chart is a 90-year historical chart of the S&P 500 index. You can see from 1928 to 2021, there's been several ups and downs in the stock market. However, you can see that the long-term trend of the stock market is always up. In regards to financial advisors, when does it make sense to hire a financial advisor? Well, when your investments grow to $500,000 or more, or you reach a high level of complexity, or you don't have the time to manage it on your own. What type of financial advisor should I hire? A fee-only fiduciary. And you want to get multiple quotes from different financial advisors. You want to ask some questions and listen to your intuition. Do you feel comfortable with this person? Do you get a good feeling? Do they have several years of experience? Are they trying to sell you on other products, etc.? You can even ask to see their certifications, etc. What is a fee-only fiduciary? A fee-only fiduciary means they do not receive commissions or other payments from providers of financial products they recommend to clients. Fee-only financial advisors act as a fiduciary. It means they are legally obligated to put their clients' interests first. Free, reputable sources of financial information for you. Again, The Money Guy Show on YouTube, that's Brian Preston and Mr. Bo Hansen. The company that their website you can go to is aboundwealth.com. Jeff Schmidt has a YouTube channel called Holy Schmidt, and his website is holyschmidt.com. Again, this is not a promotion. I'm not getting paid to promote these gentlemen's websites or companies. These are the websites I follow and have learned a lot from. Lastly, jazzwealth.com. Jazz Wealth Managers is also a fee-only fiduciary, and they have a YouTube channel called Jazz Wealth that you can look up. I hope this information helped. Please like, share, subscribe, and leave me a comment for future video topics you would like me to cover. Thanks for watching.